Yeah, welcome back. This is now the chapter 8 on formal aspects of VAT cases. And you see here on the slide already where we have to deal with taxpayer. Who will that be? Tax arisal. So when is the tax due or when has it to be declared? What can be said about the invoicing rules, and some tax declaration duties might also be shortly commented. Let's begin at the beginning, so with the taxpayer thing. And in general, all the formal aspects deal with who has to do tax paying, at which time, how has it to be declared, and so on. And now, if you want to memorize which aspects here have to be checked at this stage of the testing scheme, then my recommendation would be that you just remember that it is how the tax has to be paid. So the P is for taxpayer, who is the taxpayer. The A is for arisal of the tax, which means at which time does the tax liability come into existence. The E, oh no, the I pronounce it in the German manner, the invoicing aspects, and the D is for declaration duties, so you can easily remember which aspects are to be dealt with under the headline formal aspects of the tax at the end of the testing scheme. But now, ladies and gentlemen, let's begin with the taxpayer. The basic logic behind all that is the tax should be collected in a convenient way, which makes collecting convenient, but also guarantees legal certainty. So when the law says we want that taxpayer where things work best, so that is why we take the entrepreneur. You need to write that clearly into the law. Usually it will be the entrepreneur, but under certain circumstances, others are more convenient as taxpayers from the perspective of the tax legislator. And so that is why then they choose these people. And so it's not a trivial question to find out who the taxpayer is. The basic idea is usually we take an indirect tax in order to be more convenient in collecting the tax. It's far more easy to address one business owner for the tax on everything which his or her customers consume than to address the individual 1,000 customers and ask them for a tax declaration. Yeah? That's usually our reason why we establish an indirect tax and collect the tax from the entrepreneur. Now, there might be special situations where it could be more convenient to address, let's say, the customer or a third person and ask them to take care of paying the tax. So, for that reason, the law has to explicitly regulate who has to pay the tax for which transaction, under which circumstances. Will it be the entrepreneur? Will it be the customer? Will it be somebody else? These questions have to be regulated clearly, because otherwise you have a big confusion. So in German law, you can find the rules on taxpayership in paragraph 13a and 13b of the Umsatzsteuergesetz. In the EU directive, the articles 192a to 205 deal with the problem. So you see, evidently there is a multitude of rules. So the sheer extent of the articles already shows you it's not always a simple thing. So the basic rule is naturally, if there is no special rule, take the entrepreneur who made the delivery or supplied the service. 13a, number 1 gives us that rule, so that is something which you can cite every time when you have no other idea. But or you could look that up in Article 193 of the VAT Directive. Now, this general rule can always be put aside by a special rule, so you can only be sure that it applies if you have tested the case for all the special rules too. And so you need to deal with that point in the testing scheme under all circumstances, and you need to know where to look up and test all these special rules. The taxpayership must be tested first because it also has an influence on the arisal of the tax and especially on the invoicing rules. So this is logically the first thing which you have to test. Now, the deviation from our general rule, entrepreneur is the one who has to pay value-added tax. The deviation would be customer pays, and there are two constellations where it makes more sense to demand the tax from the customer than from an entrepreneur. Constellation number one, the entrepreneur is outside the country and the customer is inside the country, and the customer is somebody who is familiar with the rules of VAT. In that case, it is probably easier to ask the customer to make the tax payment instead of trying to collect the tax from an entrepreneur who is a foreigner and who you can't catch, whom you can't properly approach and easily approach in order to demand and enforce the tax payment. Constellation number two are a multitude or a set of cases where the fact that the entrepreneur owes a tax to the fiscal office and that the fiscal office has then to give a refund to the next customer if the next customer is a business owner, where this constellation leads to tax fraud, or at least to a high risk of tax fraud. In that cases, also shifting taxpayership to the customer can bring unexpected improvements or amelioration of the situation. So, in both cases, we speak of the reverse charge regime or reverse charge rule because, the normal situation that the entrepreneur is going to pay the tax is here reversed. The charge is given to the customer, and that just reverses the normal tax charging system. And that is where that term comes from. Let's now have a closer look to the different situations. First, the sense and effects of the reverse charge solution in cross-border situations. Article 194 of the VAT Directive allows the application of reverse charge solutions in all cases where the entrepreneur who made the delivery or rendered the service is not resident in the country where the tax has to be paid. So the member states have here a clear choice to decide that they want to take the customer instead of the entrepreneur as taxpayer. This is an option for the member states, so not the persons involved have the right to choose, but the member states decide in their VAT laws if they use that option or not. So that brings a kind of uncertainty into the application of VAT law, because if you do a cross-border transaction and if that transaction becomes taxable in another country, you will have to find out if you are not an entrepreneur from that country. You will have to find out if in that other country you are still the taxpayer, or if that other country makes usage of the reverse charge solution so that not you, but your customer has to pay the tax. For that, you usually need a tax advisor in the other country. In principle, the VAT Directive allows to shift the tax burden to the customer and poses no additional conditions. So you could also, as a member state, name a private consumer as a taxpayer under their VAT law. But naturally, most states will not do so. Private persons are famously uncertain and unknowing, helpless when it comes to VAT. They have no bookkeeping, you can't check anything, you will check nothing, and so your VAT claims will probably be lost. In that case, probably a state prefers to collect the tax from a foreign entrepreneur. But in principle, it would be possible that you even shift the reverse charge burden to a private consumer in the other country. For some cross-border constellations, and that's now very interesting, the reverse charge rule is even compulsory in all member states by the rules of the VAT directive. That is especially the case where service has been rendered. The place is to be determined under the general B2B rule of 3A2. So in the country where the customer has established its business. In that case, the customer is always an entrepreneur, so always somebody who must be familiar with the VAT rules, so that there is no risk that that person doesn't know about taxability and taxpayership. And if that person is also a VAT entrepreneur, it's also at least guaranteed at a certain level that you can and will check from time to time if that person fulfills his or her or its obligations regularly and correctly. And the third condition here is if it's a cross-border situation. So compulsory reverse charge system is established in all cases where you have rendered a service covered by 3A2 and the entrepreneur rendering that service is a foreigner in the country where the tax is due. So you find that in Germany in paragraph 3B1 USDG, which is explicitly limited to exactly these cases and says in that cases the customer or customer entrepreneur owes the tax to the fiscal office, so that the price paid to the foreign entrepreneur will always be a net price. In such a case, naturally, the foreign entrepreneur cannot charge and confirm VAT in the invoice because he or she does not get a gross price including VAT, but the price paid to the foreigner is just a net price, and the customer is the person who transfers the VAT amount on top to the fiscal office directly. So if a foreign entrepreneur in such a case gives you an invoice confirming VAT, that would be wrong, and you could not claim that as input VAT due to the rules on receiving and accepting an invoice which over-confirms or overstates VAT. Well, now, in order to avoid things going wrong, the states involved, state of the customer and state of the entrepreneur, want to check the correctness of the VAT treatment of that situation. And so the entrepreneur is obliged to hand in for the information on the transaction with the VAT identification number of the customer, and that will be passed on via an electronic information exchange system to the state of the customer. You have then to give the VAT identification number of the customer, the VAT identification number of the entrepreneur, and the net amount of all the transactions which were covered by this rule and happened within the relevant period for which you make the declaration to the automatic exchange system. That is called a recapitulative statement, and in German it would be zusammenfassende Meldung, which in Germany everybody knows under ZM, so the abbreviation of the initial letters. How does it work? The simplification effect of the reverse charge system in a cross-border situation. You have the inland customer who is an entrepreneur, so knows the rules and lives in the inland or has a firm in the inland. That person now hands in a tax declaration to his own tax authority declaring the services bought from an entrepreneur abroad and pays the tax. The foreign entrepreneur just hands in the recapitulative statement to his own tax authority, and that's it. Doesn't need to do more. The foreign fiscal authority passes on the information automatically to the inland fiscal authorities, which can check if they also got the appropriate amount declared from the inland customer. Now the inland fiscal authorities can enforce their tax claim within the own country. They don't need to write letters to foreigners. They don't need to try to confiscate property in the foreign country with the help of the foreign authorities. All that is unnecessary. They can directly address the taxpayer, that is here the inland customer in the inland. No contact with foreign taxpayer or foreign authority is necessary to enforce the tax claim. For the foreign entrepreneur, no contact with the foreign tax law and especially no contact with foreign tax declarations, foreign authorities and the inland fiscal authority is necessary. So all that complicated cross-border contact is also avoided for the foreign entrepreneur. Everybody can stay within his or her own legal system and fill out the domestic tax return sheets only. So a great simplification for all of the people involved. That's why reverse charge system, so that the taxpayer is the customer, sounds complicated, sounds as a deviation from general principles, but is in principle really great in practice. Now, you have reverse charge rules sometimes also in inland cases, and here the motivation is a completely different one. It is here meant to reduce the risk of tax fraud. Now, how can you imagine how could that reduce a tax fraud if the customer has to pay his or her own VAT on the goods or services which he or she bought? Normally you don't understand that. So let's try to explain in which situations that plays a role. Imagine entrepreneur E has to pay the tax to the fiscal office. Now that entrepreneur renders a service also to customer C, who's also an entrepreneur. So customer C gets an invoice plus VAT and can reclaim the VAT as input tax refund from the fiscal office. C does so, so the fiscal office pays out the amount to C. Now the fiscal office waits for the payment to come from entrepreneur E, and now, surprise, it waits and waits and waits, and that payment never comes. So in that case, just by chance, the fiscal office lost money, paid it out to customer C. Customer E never paid. And if that was a prearranged scheme, then it's a very clever tax fraud scheme, because this way, let's say 1.9 million input tax were refunded to C, which never were collected by the fiscal authorities. And if now E and C afterwards leave the country and go to a very foreign country and live a happy life there with the 1.9 million which they tricked out of the fiscal authorities, that would be bad. But this is how it works. In such a case, you force the fiscal authorities by fulfilling all the conditions for the input tax refund to give the refund, and then you try not to pay the tax to the fiscal authorities so that they lose money effectively. That's far more attractive than just committing tax fraud in the area of income tax, because with income tax you can only commit a tax fraud and, let's say, not paying the taxes of 1 million if you manage to earn 1 million. That's not easy for everybody. But in that situation here, the only thing which you have to do is to do a bit of business or to fake it in a way that the fiscal authorities believe in it, and then hand in a tax declaration which is accepted and grants you a refund, and then you should arrange a nice way how entrepreneur E can vanish or go bankrupt or otherwise escape the obligation to pay. Now, naturally, this is something which the fiscal authorities don't like. And how can the reverse charge situation or mechanism change that and reduce the risk of tax fraud? Let's see the same constellation now if we have the reverse charge rule applied to the transaction from E to C. Under the reverse charge rule, again, C naturally has a refund claim, but now the fiscal office has a claim for payment to C. So, under regular circumstances, the payments 2 and 3 are absolutely identical and add up to plus minus 0. Surprisingly now, the fiscal office does not have any claim against entrepreneur E. So if E goes bankrupt, vanishes, never pays, the fiscal office doesn't care. They don't have a claim. From their perspective, E can vanish into nowhere. They don't bother about it. Now, what happens if customer C thinks, okay, then I'm going to vanish? Well, what will the fiscal office do if C vanishes? Well, they say if C vanishes, we don't care, because C has to pay the tax under here number 3 in the same tax declaration in which C also makes a refund claim. So that would be C owes us 1.9 million, and we have 1 second later to refund the 1.9 million if C has an input tax deduction claim, plus minus 0. So if somebody vanishes which owes you in total a debt of 0, you don't care about that. He can stay, can go, fiscal officers don't care about it. And this completely changed the financial risk situation. And that is why that reverse charge case or reverse charge system gets more and more introduced for inland cases where there is a strong risk of tax fraud. So everywhere where such risk can be seen, one wants to apply that solution. It greatly helps. On the other hand, you cannot change taxpayership on your own discretion completely. You need to act within what the VAT directive of the EU allows. Now, fortunately, the EU directive gives a list of situations for which the member state has the right, so it's again an option for member states, to introduce a reverse charge solution. And in some cases, even member states can additionally apply for an exemption or exception where they can get the permission to apply the reverse charge solution to additional cases where an urgent need for fighting tax fraud risks seems to be given. In that case, you see again what that means for legal certainty. You get the information if you are the taxpayer or not. If such an inland case is a reverse charge case, naturally, in your own VAT legislation. So in Germany, in paragraph 13b USDG. But If an entrepreneur does something which is taxable not in Germany but in another state of the EU, then you can only know from that in the other state tax will be due, but you don't know without having read their law if they declare you or your customer to be a taxpayer. So you will have to do some research. That's highly inconvenient because in order to be sure about the legal treatment, if you are the taxpayer or not, you will probably have to contact a tax advisor in the other country. The problem is you don't have a choice. You just have to obey the foreign law and they have the choice. So customer and entrepreneur can't agree on if they prefer reverse charge or not. By the way, as it is an anti-fraud solution, leaving the choice to the people involved would naturally not end fraud situations. It would make them nearly explode. Because then all tax fraud people would always opt for regular taxation, so you could not get rid of the problem with that. Now, where do these rules apply? Well, everywhere where a fiscal authority sees that the number of tax fraud or tax fraud attempts goes up, they try to apply to the European Union to a change of the rules or to give them an exemption from the general rule that taxpayer is an entrepreneur. And so more and more cases come onto the list. The problem is that is different in every single member state of the EU, so you can never be sure that if taxation has to be done in a foreign state, that in such a case the reverse charge system does not apply. So you always have to check if a certain transaction is subject to reverse charge or not. By the way, when something happens in Germany, you also have to check the catalog of all reverse charge transactions. Naturally, with your own law, Germany, you have more chances or a better chance to have a good overview about all these cases and to recognize one of them spontaneously if they show up. But until you have become an expert, the only thing which is mandatory for you or which can help you is you always have to read the catalog of reverse charge transactions in 13b1 and 13b2 of the German legislation. And even if you have become an expert, you have to read it again and again, because in the course of time, the catalog of transactions which is subjected to reverse charge is or tends to become longer and longer, because tax fraud people have more and more good ideas, and so the fiscal authorities naturally have to react. Okay, so the only thing which is mandatory, which is absolutely necessary at the point where the taxpayership has to be tested, is read the law if a reverse charge rule is to be found there. The only exception where you can be relatively easy certain what happens is the situation which I mentioned before, where we have a mandatory reverse charge rule for cross-border situations. That was the situation which was named in 13b1. Now, as most of the cross-border situations are already covered under constellation number 1, either in 13b1 or in the German text 13b2 number 1, the tax fraud avoidance cases of reverse charge are mostly relevant in inland cases only, because most of other cases are already covered by general rules for cross-border situations. In German law, you can find the list of reverse charge situations in 13b2. The list becomes longer and longer during last decades. It began with a very small list and is now more than 10 entries, and every 2 or 3 years, another entry comes on top. So reading that every time is important. If you face the question who is the taxpayer in a case solution, no, in a case which you have to solve, naturally. If you face it in a case solution, it's no problem. If you have to give the solution, then it's a problem. Then you must know that the reverse charge rule can be found in 13b, and there you have especially to look on two parts of the paragraph. 13b1 or 2 contain the list of transactions for which 13b applies, and then you also have to check if the customer is also the right kind of customer, and that is regulated in 13b5. Usually the requirement is that the customer must also be an entrepreneur or a juridical person, so somebody who has a bookkeeping can be checked and who must have a basic knowledge of legal rules, and that is only guaranteed with an entrepreneur or a juridical person, not with private persons. For a few special constellations, more is required. For example, in Germany there is a reverse charge rule for construction works, but only if it's done for another construction firm, not if it's done for a regular entrepreneur as customer. The same applies to reverse charge for in the cleaning business, for example, if there is a firm which does cleaning of buildings for another firm which is active in the same sector. So if a subcontractor acts for a general entrepreneur, then we have here a reverse charge requirement. In other cases, we don't have it. So if we want to sum up what you have to memorize at all, then you have to read 13b2, or in cross-border cases also 13b1 plus 13b5, and then you will be wise enough to solve a case. In special situations, even others may be declared taxpayers, so people who are neither the entrepreneur nor the customer. That's relatively rare, but in case of an importation of a good from a third country, everybody who crosses the border and has the good in possession can be made the taxpayer. In case of a so-called inter-community acquisition of a good, always the acquirer is the taxpayer. And in cases where goods are taxed in a fiscal authority approved warehouse, where everything which is stored is in tax-free status, then the person who removes the goods from that warehouse will be declared taxable, and even the holder of the warehouse will be liable for the correct payment or for the correct, let's say, the correct obtaining of the data or the personal information of the person who takes the goods out of the warehouse. So I probably just expressed that in a way that you can't understand it. So the taxpayer, if somebody takes out goods from a tax-free warehouse, is the person who takes it out, and the holder of the warehouse is liable to the fiscal authorities if the holder doesn't take a note of the data which are necessary to identify who that person was. Number 4, there are some other additional cases which are of minor interest and so which we can ignore here. Under the EU directive, the member states also have the right to declare others than the taxpayer as joint and severable liable for the amount of tax if by a violation of duties which these persons have, the member state suffers a loss or can no longer identify the correct taxpayer or such a thing like that. For example, the best example for that would be the holder of the warehouse, who is made responsible for the financial loss of the member state if he or she does not really register all the necessary data which are necessary to identify the person who took out the goods from the tax-free warehouse and so is the taxpayer under the law. Well, okay, now, ladies and gentlemen, arisal of the tax. What does that mean? The second most important question when the formalities are in play. The arisal is the moment when the tax liability begins to exist. After tax liability has begun to exist, it's clear you have to pay the debt from the tax until the due date. Before a tax liability exists, you cannot pay because nobody can pay on a debt which does not yet exist. You can't pay back, for example, a credit to a bank before you have got one. When you have got it, you can pay it back prematurely before the due date, but you cannot pay something back which you never got. So the arisal of the tax is the earliest moment when you can pay off a tax, and after the arisal of the tax you will have to pay it off. Now, the arisal of the tax also determines the period for which you have to declare the transaction. Because if you not declare the transaction and the tax for that period during which the tax arises, then you hide information from the fiscal authorities. You gain a fiscal advantage by that because then you have to pay only later. And that would be already enough to call your behavior a tax fraud. In the testing scheme, arisal of the tax must be tested after taxpayership, because if the taxpayer is the customer, then there are also special rules on the date of arisal of the tax. So you first have to check if we have a reverse charge case or not. So, and if you want to memorize that, think of the word paid, you know, P for payer, A for arisal, I for invoicing details, and D for declaration duties. Here we are at the A, the arisal. By the way, you should know, if you have not yet got the information from somewhere, that in Germany the tax declaration formalities are organized that they happen in 2 steps. At the end of the calendar year, you have to hand in a tax declaration for the complete year, which completely lists all the input and output. So where everything is summed up. But during the year, there are preliminary tax declarations to be handed in for shorter periods of time, usually for 1 month, where the entrepreneur has provisorily to declare all the relevant data for that period. And although it's only a provisory declaration, preliminary, you are obliged naturally to tell the fiscal office the truth. So lying or hiding information in that preliminary declaration would already be a tax fraud. And the arisal of the tax usually refers to the preliminary declaration period and says very often you have to, or tax arises at the end of that preliminary declaration period during which the transaction has been made. Usually the preliminary declaration period is 1 month. So at the end of the month you have to make your preliminary declaration. And for certain small and medium-sized enterprises which owe only a very low amount of VAT, it is possible that the preliminary declaration period is a quarter of a year, or that the fiscal authorities even renounce on preliminary declarations if you have not only a low but a very low amount of value-added tax to pay. In all other cases, you have to hand in the preliminary declaration after 10 days after the period for which it has to be made ends. With permission of the fiscal office, you can extend that due date by 1 month, but yeah, not more. In your preliminary tax declaration, you not only declare your tax basis, but you also have to compute the tax which you have to pay over to the fiscal office yourself. And after the preliminary declaration has been received and accepted, you automatically have to transfer the money to the fiscal administration. If they are not agreeing with your preliminary declaration, they will inform you about what else they demand, and then you get a tax notice about the deviation. For the arisal of the tax, there are two different possibilities in the normal situation, because there is a regular and an optional tax arisal regime. The regular one is that what usually applies to bigger enterprises or to enterprise of the usual importance. Only for small and special enterprises you can opt for that optional tax arisal regime. The regular scheme has as the basic rule that the tax arises at the end of that preliminary declaration period during which the delivery or service was made. That's in paragraph 13. If a prepayment was made before, then the prepayment has already provisorily to be taxed, and later, when the delivery or service has been completed, then the tax arises definitively and the prepayments are set off against the final tax obligation. A prepayment shall also already be confirmed by an official invoice which shows the tax base and the tax included in the prepayment, so that the customer which you charge with the prepayment already can set off the VAT in that prepayment as input VAT from his or her own VAT obligations to the fiscal office. This regular tax regime has consequences, or how does it work? If something is not directly paid, but paid in installments, then the tax arises when the transaction is made and not when the money comes. So it is sufficient that you completed your service or delivery. Nobody allows you to wait with the tax till the money comes. The legislator thinks if you give the customer time to pay later, if you want to give your customers a credit, that's your choice. You are allowed to do so, but you don't give credits concerning my part of the money. You have to pay your obligation towards me, the fisc, immediately. When the transaction is made, then the tax is due. So if the tax arises, if a good is delivered in April, and the first installment of the payments arrives in May, then nevertheless the full tax on the tax base, so all what will be paid by the customer, the full tax arises at the end of the preliminary declaration period during which the delivery was made. When the payments come, has no importance. The delivery was made on the 2nd of April in my example, so at the end of April the tax liability arises, so it has to be declared in the preliminary declaration period for April. Furthermore, when there is a change in the tax rate, and you take an order in December where the rate is 16%, and the delivery is finally made on the 10th of January, but then the rate is already 19%. The tax arises on the date when the delivery is made, that is in January, and in January the law already demands 19%, so the arisal of the tax also determines which version of the law has to be applied. If you have a delivery made in year 1 when the tax rate was still 16%, for example, and the customer pays in installments, and imagine in year 8 an installment still comes with 500 euro per month. Now the arisal of the tax was when the car was handed over, that was in year 1, and at that time the rate was 16%. So for the installment of 500 in year 8, there is still an underlying rate of 16% included, but that must not matter very much because all the VAT on that transaction has already been paid in year 1 by the seller, because at that time the tax liability arose and had to be paid completely by the seller. How that money came in later, that didn't matter. Furthermore, if a price change occurs, you remember paragraph 17 USDG, the change in the VAT naturally has also to do with the transaction which was originally made, and so the change under paragraph 17 is judged under the same conditions as at the time when the tax arose. So if a price is changed later for a transaction which was made when the tax rate was 16%, then also the change, the correction of the original situation, still has to be done under the 16% regime. Because it would be strange if first you charge or you pay 16% to the fiscal office, and later if you then reduce the amount, you get back more than 16, namely 19% from the fiscal office. That would be a nice tax saving model. So the tax rate which was valid at the moment when the original tax arose also counts for all later changes of that tax amount. Now let's have a look on the alternative, the optional tax arisal system that's possible for certain small and medium enterprises and for certain members of the so-called free profession, like lawyers, tax advisors, inventors, engineers, or so. In certain cases, which then can be found described in paragraph 20 USDG, the entrepreneur has the right to opt for an alternative regime of tax arisal. Then the tax arises only when the money is received. The first thing you must notice is this optional scheme only applies if somebody opted for it. So if you have a case to solve in an exam or wherever, then if there is no information given that such an option has been chosen, then it's clear it is not relevant for the case. The regular regime applies. What does this payment when money comes imply? Well, the first and most important thing is if a customer pays in installments, then the tax arises, so gets due and has to be declared with each individual installment only. So then the tax gets due when the money comes And if the money comes in installments, then the tax arises in installments. So if somebody really buys a car and has to pay an installment of 500 euro plus VAT each month, then each month only a VAT of 95 euro would arise. The important thing which you must keep in mind is nevertheless, if the tax situation changes, so if the law is changed, nevertheless, usually the transitional rules say that if you made a transaction in December 01 and at that time a rate of 16% applied, then this rate will be still valid for all future payments for that transactions, which are either received or given back. So every change under paragraph 17 of a tax base would normally, in the regular system, be dealt with under the original rate, and the change to the optional tax regime is not meant to change anything else than the payment date. So the original rate remains valid and applicable here too. By the way, in Germany, everybody knows these two systems under the terms of Soll taxation, that is the amount which is owed is directly taxable. The other alternative is Ist taxation, which is the optional regime, and Ist means that what is just paid. So that is the usual keyword to keep the two things apart. Yeah. Some special rules for the arisal of the tax can be found if we have a case of paragraph 13b, reverse charge. Then you must know that you have also to look up the arisal of the tax in the 13b rules. And here you must notice that the arisal of the tax is regulated in paragraph 13b(1) differently from how it is regulated in 13b(2). So you have to look up exactly what is stated in the relevant passage of the Tax Act. And one hint must be permitted. One very special rule exists still for a very special situation. If you issue a wrong invoice, so an invoice where you confirm more VAT than is really correct under the law, then you know that you are liable and have to pay the exceeding amount of VAT just because you issued that wrong invoice. In that case, the law says the exceeding amount is due at the moment when the invoice is issued, 13.1 number 3. And this is everything concerning the arisal of the tax, and I think it's now time for a break because the next sub-chapter will be invoicing rules and declaration duties and so. And I genuinely have the feeling that all of us probably need a kind of a. And just as a last remark, I fear that you could notice how much I like that topic, at least to describe it in an abstract way is simply really boring. One can best train it on real sample cases where one has to find a solution, but we are going to do that later. So, ladies and gentlemen, not only you need a break now, I also urgently need one, because otherwise motivation would horrendously go down. So, if you are still alive and survived that short essay on formal things, thanks for watching. If you stopped before you arrived here at the end, I can understand your feelings, but I would greatly appreciate if you come back later for the last part, and then we probably have done the most important theoretical stuff. Thanks very much and have a good rest of the day. Ciao and goodbye.